Everything has gone crazy. The college football playoff system is a mess. Teams get in, don't get in. That should be. Teams that are ranked lower than other teams jump over a higher ranked team at the end. Like, for example, Miami and Notre Dame. And then Notre Dame says, oh, well, we're not going to be in the college football playoff. We're not going to play in any bowl at all. Well, then other teams say, we're not going to play in a bowl either. And we're not going to play in a bowl either. And now you're thinking the entire bowl system could go the way of the dodo. We could scrap it and start over, which would be good because those things have been obsolete for decades. But this isn't a show about me lamenting on college football postseason. Welcome to Covering HOAs with One Hot Mic. I have been given the fantastic opportunity to travel around and talk to people about stuff that I'm super passionate about. And that's making sure that people know how they can protect their assets using insurance. A lot of that centers around showing them or just defining for them or describing for those folks what an insurance policy is, what it covers. But I don't know that we spend enough time talking about the things that impact insurance premium, the things that insurance companies look at that drive the cost. Because as we've mentioned before, we've discussed before, insurance is a piece of a risk management plan, a risk management program. It's not the whole thing. We feel like it is, especially when we've been in the hard market that we were 5 years ago. Since then, the market has been hardening and hardening and hardening, and now it's concrete. In that soft market, we could say, hey, insurance company, I want to give you money. You take on my risk. And they'll say, yes. And now they're saying, well, I want to take your money, but you have to do these risk mitigating steps first before we're going to consider you. Because the risk management program, yes, insurance is a part of it, but it also includes accepting risk, controlling risk, and avoiding risk. And insurance companies are saying, and by the way, we're talking about the risk of a financial loss, so the risk of spending money to fix property, or the risk of spending money to defend some sort of liability claim. These insurance companies are saying, sure, I will accept your risk. The cost of my acceptance has gone up. Otherwise said, premium is rising. And in order for me to accept your risk, in order for us, I should say, to accept your risk, we need you to have done an update on your electrical panels, or if there's trees in the property that are going to potentially fall or damage the buildings, we need you to remove those. We need you to avoid risk as much as possible. We also need to look at your reserve study and your financials and see how much money you have, how fiscally strong are you, stable are you as an association, because if something does go wrong, we want you to be able to spend the money that's necessary to control risk, maintain your property, replace the roofs when they need to be replaced, repaint the buildings when they need to be repainted, resurface the asphalt drives, streets when the time comes. We want to make sure that you have the money in the bank to do that before we are going to continue, or before we're going to accept your risk. And that is a difficult thing for a lot of boards, a lot of communities, because board members are volunteers, board members are members of the community, and board members don't want to see their assessments go up. And a lot of times board members campaign, if you will, on, I won't raise assessments. You have to. You have to raise assessments. You have to keep in mind, I think I spoke about this before, and I'm going to drive this point home until it gets there. You have to keep in mind that the only way your company, your corporation is going to earn revenue is the form of assessments. Now you can have it be monthly assessments, or you can try to get emergency special assessments or special assessments voted on and passed by the membership. But either way, you're going to pay for it. So you might as well do everything you can to plan for having that financial stability, that safety net, being able to maintain your property. And then the insurance company will say, okay, you've avoided risk where you can. You have control of risk that we want you to have. And we will now accept your risk transfer to the insurance company. But when we do that transfer, when the insurance company does say, okay, I'll accept your risk, there are also factors that they're now going to consider as far as we call it their appetite. What do they want? What are they willing to write? This is one of the reasons why insurance companies have said, we don't want this property because it's in this location, because it's in this wildfire or brush area of concern. And that just doesn't fall into their appetite. So the insurance company says, you know what? I don't want to write that. Now, we as a consumer feel, why are you canceling me? What did I do? Nothing. You didn't do anything. We're just breaking up, I guess, was a good way to put it. It's not you, it's me. But we don't want to be together anymore. You don't do it for me anymore, I guess. And so all of those underwriting factors are things that preferred carriers like Farmers and State Farm and Philadelphia and Travelers, the names they consider, and they might be a little bit more conservative on the risks that they accept. And once you leave those markets, you end up in a surplus market where costs are higher, carriers are limited, and there's more underwriting of certain types of risk. For example, if we are in a small community that has, let's say, 25 units, there's no pool, there's just a park or an open area of grass, maybe a couple of streets, because it's only 25 units, could even be one street. We don't have a lot of amenities to worry about. And the insurance company's not going to ask very many questions. Okay, 25 units, this number of doors, therefore the premium is X. But if we start adding specific amenities, if we start adding things like pools, fitness centers, clubhouses, some of the communities that I've spoken to in Texas and Utah are large scale developments where they have multiple pools, some with water features, water slides, water play areas. Some have diving boards. Some allow for swim meets, have swim competitions with other other communities in their area. Those are all risk factors that an insurance company starts to or does look at and says, okay, well, those risk factors are increasing my exposure. They are increasing the potential for loss or the potential for property loss. And therefore, I need to account for that. And with most of those preferred carriers, when you add those high risk amenities, the carrier says, I don't want it. It's not within my appetite. Okay. So we need to find a way to ensure that. There's always a way to insure something. I'll hear it a lot where someone says, well, I can't get insurance. Yes, you can. Yes, you can. You just don't want to pay what you're going to need to pay in order to get insurance. But you can get insurance. End of the day, Lloyd's of London will write almost anything. I think Mariah Carey's vocal cords are insured by Lloyd's of London. Though they do have a requirement, I think, on their policy that says, however, these vocal cords may not be used at any time during the year until after Thanksgiving. Pausing for the printer. Hey, hi.
I won't do it again. Sorry.
That's okay. We're still waiting. By the way, did you say hi to Chris Max? Their names are Max. Holy cow! I don't remember what the last thing I said was. Boy, it was a good point too. Mariah Carey's vocal cords are insured. Anything can be insured. So when an insurance company doesn't want an HOA, the HOA doesn't fit their appetite because they have XYZ amenities and therefore more property exposure or more liability exposure than the carrier wants to take on. We go to another carrier that is willing to do that, but for a higher price. And that's where the market has gone in this hard market space. When an insurance company is evaluating an exposure, evaluating a risk, they're also looking at how quickly is something going to be addressed if there's an emergency or if there's a need. Is there a property manager, community manager, I should say, not a property manager, a community manager? We're talking about HOAs. They are community managers. They are not managing the property for another owner. They are working with the board of directors as an advisor. It's not like an apartment complex where that property manager can say, all right, I'm going to go get this person and this person and this person. I'm going to pay them. And then I'm going to have the property owner reimburse. The community manager probably has some freedom, some guidance from the board on what they can do to address certain things and what contractors potentially they can go out to address a concern. But at the end of the day, the board of directors is the one making the decision and signing the checks. So you are a community manager, not a property manager. My view. But that's why all of our stuff in CAI, CACM, all the other organizations that are devoted to the common interest development space call managers community managers, not property managers. Is there a community manager on site that can address something that happens immediately? Does a phone call have to go out to a community manager who's not necessarily attached to that community 24/7? A lot of time we call these portfolio managers. A lot of times these managers might have 3, 5, 10 different accounts that they're working with. So their response time might be a little lower. Do you do special regular inspections? Do you do regular community walks? Most communities have a 30-day cycle where the board and management or board members or committee members and management meet with certain contractors, say, for example, landscaper, and inspect the property and make sure there isn't anything that needs tweaking. That's a very good practice. Document that stuff if you do it, because you can report that to an insurance company, and an insurance company says, okay, that makes me more comfortable, right? If this is my comfort level and you don't have it, then my comfort level goes up, plus. And then if you do have it, then I feel better and I can lower your rate. And then what other oversights do you have in place for contractors, vendors, business partners to make sure that what you can transfer to them, that's the additional insured endorsement that everybody asks about. Hey, do we need to get this painting contractor to give us an additional insured endorsement or a certificate of insurance? Yes, you do. Because you are asking the contractor to do their job, and the contractor is going to do their job, but you don't want something the contractor does doing their job to affect you, because you weren't doing their job, you were doing your job. So the additional insured endorsement transfers the liability that the contractor has created to the contractor completely. It takes it away from the HOA. Painting contractor is a good example. Painting contractor on a wall, overspray Mercedes. Mercedes owner says, hey, you HOA hired this contractor, therefore you are partially responsible for the damage to my car. Additional insured endorsement says, no, we're not. See contractor. So that's a form of vendor oversight, business partner oversight that protects the association. All of that works its way into how an insurance carrier views an account. And we are going farther and farther down this risk mitigation path before an insurance company will accept an exposure. We're not going back to where we were 5 years ago, where we could say, I want an insurance policy, and the insurance company will say yes. We're not going back there. we will from this day forward be looking at what other risk mitigating steps have you taken as a community to help us be comfortable with your risk. Other questions that insurance companies ask: do you have social events? Do you have parties? What do you do? Do you rent out your clubhouse? When you rent out your clubhouse, or when you let an owner use your clubhouse, use the clubhouse for a private event, what do you do to protect the association from the lack of control the association has on what's going on at that event? Are you serving alcohol? Are they serving alcohol? That could be a big deal, not only at the event, but after the event. There are tons of stories of event attendees leaving an event intoxicated, inebriated, getting into an accident, and then suing the association because that's where they got the alcohol. And the association should have known not to serve or overserve this person. There is a high level of individual responsibility in those cases, but it doesn't mean the suit doesn't get put forward. It means the association ultimately has to defend itself. So whether that's a $7,000 defense or a $100,000 defense, it's important to have your ducks in a row, as it were. So if you're renting out your clubhouse or you're letting a member use your clubhouse, require your member to provide an event policy or proof of insurance, additional insured endorsement that says for the period of time that I'm in control of this clubhouse, the liability that I've created, the liability exposure that I've created, I'm taking on myself. And if somebody says the association was involved in that, then I will take it on. That they will get defense from me. So me homeowner, me unit owner, me homeowner, me unit owner. I'm the homeowner, I'm the unit owner, and I want to have my daughter's 5th birthday party in the clubhouse. I can reserve the clubhouse. I may have to pay a fee to the HOA. That's fine. And then I'm going to provide a single day event policy or proof of liability insurance with an additional insured endorsement. Most insurance companies, in particular condominium unit owner insurance companies, will not add the association as an additional insured. I have seen this done many times where the agent or broker just provides a certificate of insurance, but that's the accord form. And if you read the accord form at the top, it says this is not insurance because the carrier wasn't going to do it. Yes, the risk is minimal. Yes, it solves the problem for the homeowner who is the client of that insurance, private or personal lines insurance agent or broker, but not covered. So I suggest going to any number of Googleable resources for private event insurance. Just Google private event insurance. You'll get more than you want to see. But get insurance, force them to get an insurance policy. Now, getting that policy, though, getting that user, if you will, to provide the proof of insurance, additional insured endorsement, does not take away the liability the association had for that space absent the event. So if someone at the event decides that the plastic folding table is a great stage to dance on, and the table collapses and the person is injured, that's on them. Or that's on the person who is occupying the space at the time, aka the unit owner, homeowner. But if someone trips and falls over a loose board, cuts themselves on a nail that's sticking out from a threshold or a doorway, that's liability that exists absence of the event. It was there before, and it's the association's responsibility to maintain that property. So the association is still liable for that, even though somebody else has a policy that's saying we have liability insurance. They have liability insurance for their event, not for the things that existed regardless of the event. Proactive measures, proactive risk mitigation may result in some premium relief. It's not a cut and dry number because it varies by carrier, it varies by location, it varies by risk, it varies by size, it varies by whatever. Point is, you potentially will obtain or receive some relief. I just can't put a number on it. A lot of times, 10 to 15%, depending on what it is. Are they safety upgrades? Have you not had any claims? Big changes might result in a larger discount. For example, upgrading your electrical, you may see a 20 or 30% discount or a reduced premium, either because that carrier gave you a reduction or because you're able to access other carriers that are going to charge a lower premium because the electrical is more acceptable. We're seeing regulatory measures kind of poke their head out of the sand and say, well, maybe we can do some of this on the state level. I'm not really for a lot of legislation telling people what to do, but I think there's a need in some cases because the incentive for a board of directors is to keep assessments low. And the only way we're going to make that change is potentially in some cases to force it. And so states like Florida are they're leaning into legislation mandating structural inspections, mandating reserve study funding, whereas we just in some states there's no reserve study requirement. Reserve study. A reserve study is a list of the assets the association is responsible to maintain, repair, replace, and a timeline over their useful life. So, for example, let's say it's going to cost me $30,000 to replace a roof, and the roof useful life is 30 years. Now, that's a really low number, but I'm doing it from my small math brain. $30,000 over 30 years. At the end of 30 years, we're going to need to have $30,000 in the bank. So what do? We reserve $1,000 a year for 30 years. And then we will have the money that we need to replace that roof when the time comes. That said, you probably won't have that money because that's 30 years. Costs of things change. Inflation, yada, yada, yada. So you have a reserve study, but then you have annual updates and a regular complete redo of the study to make sure that you're still on trend. Some communities or some states don't require that. And so some communities don't have one. They don't have a plan for how to replace property or what they're going to do with them when the time comes they need to replace property. That's where an assessment comes in, a special assessment, and that requires a massive vote. It's very difficult to get past. It's very expensive. So, like I said earlier, you're going to pay for it anyway. You're going to take a $30,000 assessment at the end of 30 years and split it between all the homeowners, or can you just reserve $1,000 a year? What's easier? What keeps your assessments? What keeps your expenses? What keeps the pain of your community at a minimum? Slow and steady wins the race. So some states don't require it. Some states just require that the reserve study is there. Some states will require annual and then a certain period of time, after a certain period of time, say 3 to 5 years, require a full reboot. Make sure you're still on the path. But if you don't have a reserve study, get a reserve study because it's going to become a requirement anyway. It, you will be required to fund it. Lenders are looking at reserve studies. I don't think they know what they're looking at, but if they see a column of zeros and the top of the heading of that column is remaining useful life, that says the remaining useful life is 0 years. The lender says, what are you going to do about these things? Insurance companies look at that. What are you going to do about these things? Why does an insurance company care? Because if the remaining useful life of a roof is 0, there's a potential that that insured is just waiting for something to go wrong so that the insurance company can be used to fix the roof. The insurance company is going to say, I don't want to put myself in a position to be your maintenance policy. So I'm not going to insure you, or I'm not going to insure you anymore because you're not mitigating the risk that we're taking on. We have no ability to do it for you. So we're just going to say, if you're not going to do it, we're not going to insure you. Now, there are some new-ish policies that are coming on the market, or that have come on the market, because new exposures are becoming more and more prevalent. Directors and officers insurance has always been there, but there's certain aspects of directors and officers insurance that are changing. Directors and officers liability insurance is insurance for the board of directors. It's professional liability. Think doctor malpractice, lawyers, professional liability, attorneys, professional liability. It is insurance for the board of directors making decisions on behalf of the community. Historically, we've been in a marketplace where the insurance carrier says defense costs are outside the limit. So if we have $1 million limit of insurance, all the court fees, legal fees are all outside that limit. We don't use up the $1 million in order to defend the insured. That $1 million is there to pay settlement or judgment. Now insurance companies are saying either A, we're going to put those together, bring in the defense costs inside the limit, or we're going to set a separate limit of defense costs, because it's becoming really expensive for an insurance company to defend a D&O claim. And the D&O claim is typically, or the D&O policy is typically, in a really big community, let's say $10,000, $15,000. But any loss is going to be, any claim is going to far exceed that number, just the paperwork. So insurance companies are saying, okay, well, I can't be an open faucet. If you want me to be an open faucet, you're going to have to provide more premium for me, the insurance company, to take that on. Cyber liability, cyber theft, that's electronic stuff. Those are becoming more and more prevalent. Claims are becoming more and more prevalent because more and more banking things are done electronically. Checks are deposited electronically. Payments are made electronically. The exposure really is with the management firm, if there's a management firm that's taking that on, or the management firm is contracting with to provide that service. You'd have to talk to managers. You'd have to talk to banks about how that works, because I don't know. But ultimately, it's who has the database that is the one that is exposed. And if you're a self-managed community, or a community that has managers on staff, and you're doing everything internally, first of all, make sure your community manager is credentialed, accredited, knows what's going on. Don't just hire someone who used to be an accountant. But your community manager, if your community manager, general manager in many cases when it comes to on staff, if you're the one, you community are the one holding the database, you have all the information of all of your homeowners. And let's say your homeowners have their credit card or their bank account on file for an ACH, a monthly draft of their assessment, and your database is breached. There's a ton of steps that you have to go through to notify everybody in that database, and to notify and to potentially defend yourself from a liability claim, and because you Now someone has my identity, someone gets a credit card in their name with my ID, with my information, and now my credit is ruined. So there's a lot of things that go along with cyber liability. Cyber theft is the stealing of money electronically. Again, if it's all happening electronically, then there's always an opportunity for some criminal to climb in there. We're also seeing some increase in environmental impact liability claims, depending on where your community is and what sort of amenities you have. For example, a couple of golf course claims. The lakes have a lot of chemicals. The chemicals leak. Chemicals are stored on site, potentially in underground, above ground, or even underground tanks. If you have a lot of pool equipment or you have a big pool, lots of pools, you may have chlorine tanks on roofs of buildings. Those are potentially liability exposures for the community and should be covered with an environmental impact liability policy. That's a lot about how insurance companies are charging, insurance companies are building their rates, and the things that you need to do as a community to manage your risk, mitigate risk, so that you become more attractive to the insurer, and the insurer is more comfortable with taking on your exposure. What are we seeing in the future? Crystal ball. Crystal ball. Where did I put that crystal ball? Don't got one. But I got an idea. You're going to see a lot of stability, actually, stabilization of the market, because I think a lot of the communities that are going to have the hardships have had the hardship. The community that was identified needs to be identified as a brush exposure, has been identified as a brush exposure, and those hurdles are being overcome. So I don't anticipate big jumps year over year in premium. Everything's going to go up because everything needs to go up, but I don't anticipate those big jumps. The 2026 to 2028 outlook, I think you'll see more preferred carriers continue to exit the market or limit their underwriting within the market because they just don't want the exposures, and they don't have the flexibility that excess and surplus lines has over how and when to rate or what to charge for premium. Preferred carriers, admitted carriers, and are typically governed by the state on what they can charge. We're going to move to a marketplace where we're working with more non-admitted carriers, where we're working with probably most often working with carriers of names that you don't necessarily know, but they're carriers that are committed to the common interest development marketplace, and they are just have more ability to charge the rate that they need to, until certain things come into the ability for a carrier to rate a product, a preferred admitted carrier to rate an account that in a way that makes a lot of sense. For example, adding additional endorsements, changing coverage language that fits more with the carrier's appetite versus just big broad scopes. I think when we start to do that, we'll start to see those preferred carriers return a little bit or even expand their underwriting because they'll be more comfortable with the exposure they're taking on. Though that fire risk, wildfire concern, brush fire concern, though the electrical concern for things that are over 30 years, that's not going away. So we will see some shift in those spaces. All right, I will cover you for anything except a fire that starts because of electrical until you fix your electrical. I will cover you for any fire except this type of fire, which we define as a wildfire, something like that. And then the insurance or the HOA would need to go to potentially find coverage somewhere else, like they do earthquake or flood insurance, or some cases hurricane insurance. We call it difference in conditions policy. They'd have to go find that. And then maybe we'll see some federal, further down the line, we'll see some federal insurance programs. Maybe we'll see something In California, maybe we'll see something similar to the California Earthquake Authority, which is specific to earthquake loss. Maybe we'll see something like that for wildfire. Who knows? But again, that's farther down the road. College football world notwithstanding. And rising insurance premiums and the difficulty that we have as consumers in the marketplace. This is a time of the year that can bring a lot of sadness to a lot of people. It's the most wonderful time of the year. For some. For others, it's a difficult time. And it's an important time for us to see our friends and family, to hug them, to hold them close, to cheer them up. Case in point, that's Chris Max. I have a penguin thing. They make me laugh. And I've gone through some difficult times, and the penguins make me laugh. So I keep them around, and they're all named Max, except at Christmas time. Chris Max. But we all have those times when we're not having a great day, and we need to be encouraged by others. We need to reach out to others, or others. We hope that others will reach out to us, though we're not looking for any help. And so I say to you, call your friends, call your family, reach out and say hi. Because you never know what someone's going through. I saw this morning, and I thought, this is beautiful.
I heard someone say, you have to be your best self every day. And I thought, goodness, that sounds very tiring for a small bear. Some days, my best is climbing trees and finding honey. Other days, my best is getting out of bed and remembering to breathe in and out. Both days still count. So, if today your best feels smaller than yesterday's best, that's quite all right. You are still you, and you are still enough.
Thanks for hanging out with us. Please be sure to like, subscribe, download, share, tell us you love us, or just say hi. Happy holidays, Merry Christmas, and we'll see you next time on Covering HOAs with One Hot Mic.